So there we go.
All
We
right.
can get started. Alex, thank you for the opportunity to join you on this call and to go through some cost segregation information. I'm just going to go through the general information that I normally cover, and then we can answer some questions if you have any when we're done.
Sure, sure.
So a little bit about cost segregation. As you know, it's a very, very popular tax strategy anymore. Let's see, I gotta click on it. There we go. Many people know about the financial benefits of owning commercial, real estate, multifamily, single family residents have done incredibly well the last couple of years. You get the cash flow with the ability to raise rents. Other people are paying down the loan, and the property value appreciates with growing equity. And many people know about the tax deferring strategies of a 1031 exchange. But there's another big tax deferring strategy with real estate, and that's lesser known. It's cost segregation, which can be used within a 1031 tax deferred exchange. You can do them both together. I hope to give you an overview that's easy to understand. So it's not what you make, it's what you keep. Tax strategies are really important, especially with real estate. So let's talk about cost segregation. It's basically accelerated depreciation. It's a method of depreciating your property, which gives you accelerated depreciation. It began about 20 years ago, and it's only available on income producing properties. You can't do it on the primary residence unless you're renting out half of it or something.
Yeah.
It's only the income part of a property that you can accelerate the depreciation. Originally, cost segregation was only for new construction. However, in September of 2017, they allowed this to be used on existing buildings. But the tax deferring benefits were taken over 5 years or over 15 years for the items that we identify in the study. Pieces and parts of every building qualify for being either called 5-year property or 15-year property, which is faster and more deductions than waiting for the whole building to be done over 27 or over 39 years. The Tax Cuts and Jobs Act was passed in 2017, and that changed it. So now all existing buildings that have been purchased since that time qualify. And it's not just for new construction, it's for any building, any improvements that have been purchased. And in 2017, they changed the benefit. Instead of getting the benefit over 5 years and over 15 years of the first years of ownership, you can actually take all of those deductions in 2022. You can take all of the value of that, and it's called 100% bonus. That's what it's been called by the tax professionals. So what you would normally take as a deduction over 5 years or over 15 years with those qualifying components, you can now get it all 100% applied against income. It's really an incredible strategy. It does change after 2022. It drops to 80% in 2023. Any properties that you acquire in 2023, you get 80% of the benefit of the bonus depreciation. That means 20% of that number you would take over 5 years and over 15 years, but 80% of the 5 and the 15-year components could be applied day one. And it is, unless Congress passes a law, it's slated to drop 20% in 2024, another 20% in 2025. It'll be phased out after 2026. So it's really a great strategy for anyone that acquired any properties from, let's say, September. Actually, any properties acquired in the last 7 years, we would be happy to run the estimate on, because there's probably some tax benefit on having owned those properties the last 7 years. You could go back as far as 7 years. Straight line depreciation, if you do the math, if you divide any number by 27.5 years or 39 years, you're going to get 2.6 or 3.6%. This is the annual deduction you're getting without doing a cost segregation study. So there is one opportunity. It's only in the early years of ownership that you could do this. I would say within the first 5 years, for sure it will work. 6 to 7 years, it may not pan out. But again, we're happy to run the estimate. But instead of taking 2.5 or 3.5% deduction on the value of the buildings and the land improvement, instead, I see normally about 20% can 10 times this amount.
Yeah.
There could be 20% of the value of that building that could be turned into an accelerated depreciation deduction if it would help that income property owner.
That's great.
And if
David, I want to just quickly, because some people will listen to this and they don't know
Sure.
anything about even depreciation. Just quickly explain what depreciation is and basically what we're talking about right now.
Sure.
We're accelerating depreciation, but how does it work for, let's say, for real estate?
Yeah. So basically, depreciation is a deduction the government gives you for wear and tear on the property. And you can take, I'll show you, you can take the whole building and divide the whole building, what you paid for that property, after taking out the land value, because land is not depreciated. I'm in Ventura County. A lot of the properties in Ventura, the land is about 30%. So if you bought, let's say, something for 1.5 million, you would take out roughly 500,000 for land, and you would depreciate the remaining, which is the $1 million. And that includes everything you bought with that property: the driveway, the fences, the mini blinds in the apartment, the linoleum, the carpet, that's everything. And you see, for many years, the only method was straight line depreciation. This would be the building price. You would divide it over 27 or 39 years, depending on how the property is used. For monthly residential income, it's 27.5 years. Any other property is 39 years. And you would just divide like a Big Mac, the entire property, and take it evenly. Cost segregation method, we like the Big Mac analogy because everybody that's old like me knows 2 all-beef patties, special sauce, lettuce, cheese, pickles, onions. I mean, they drilled that into my head when I was a child with the TV commercials. So with cost segregation, all we do, all we're paid to do on a study is to take a property and, if you will, reverse engineer everything that was in it that was paid for when it was constructed. We're going to put a value to everything inside that building. And some of those components you can apply immediately as deductions with the current tax law, and some of them you can't. About 80% of any building cannot be accelerated. You have to take about 80% of any building evenly over 27 or 39 years as a deduction. But let me show you some of the components that qualify, because these are in pretty much every property we ever study. But these are the items that we look for that give you faster deductions, better tax treatment. In 5-year property, which is the interior, and if you think about stuff that's on the interior of any property, there's a lot of wear and tear. So you should be able to depreciate that faster over 5 years, right? Cabinets, shelving, countertops, carpet and flooring is a big one. Any fixtures, fireplaces, baseboard and crown molding is usually at the top and the bottom of every wall. Paint, window treatments like mini blinds, accents or interior lighting, any lighting that's in the recessed part of the ceiling, all the electrical qualifies for running power there, as well as the light fixtures themselves. Ceiling fans, security systems, any interior signs, like if it's an apartment building and Space 101 in the name of the company, any decor. If you think about it, if you had a building that was just drywall and nothing else, it would not be a good property to do cost seg on. If you have let's say you have a strip mall and 3 of the 4 units are built out, but 1 is still empty looking for a tenant, that would be okay, because 3 out of 4 of those spaces have a lot of these things. But just know it's the extras. That's what we're looking for, and we're putting a value to for you. Now, the 15-year property is the exterior, and this will vary greatly on a commercial building based typically on the size of the parking lot. A bigger parking lot, a bigger deduction, quite frankly. Also, we're looking for site drainage. If the parking lot is sloped so that all the water runs to a certain area, all the excavation done by, equipment is valued to move that land around. So we put a value to the site drainage, the parking lot, sidewalks, curbs, driveway, landscaping, all the plants, fencing, gates, mailboxes, swimming pools, basketball, tennis courts, light poles, the light poles in the parking lot, the fire hydrants, retaining walls to hold back the hill in California, very common, playgrounds, exterior signs. So these are what we're looking for when we do a study of the property. And now this is an example of one of our studies that we've actually completed, and this was a condominium. So you'll notice there's no 15-year property because everything outside the condo, just like a residential or a business condo, everything's handled by a homeowners or a condo association. So the only benefit in a condominium is the 5-year property. But you can see down to the penny, we valued all the cabinets, we valued all the molding, we valued all the flooring, the seamless vinyl probably in the restroom, the bathroom, window treatments, specialty dryer vents, and electrical for appliances, all the wiring that goes to the appliances and the appliances themselves. Anyhow, you'll see in this particular property, and it's a condo, 25% of that condo valued at about $72,000 qualified for immediate deduction. And that's about 25% of this number, and this is called the depreciable basis. Any property for us to run an estimate on, we need to take out the land value and run the estimate on the value of everything that's in the actual physical property. So yes, they're still going to have 74% of the property that they would be able to take benefits on evenly over 27.5 years. But we have segregated, we have found and determined these components that qualify in the tax law, and we've put a value to them down to the penny, and we will defend an audit if it ever happens to know that this number is accurate. And again, if you can apply a $72,000 additional deduction this year in a 30% tax environment, you are deferring whatever 30% of 72,000, 20 some grand of income taxes. Now we can help with California income taxes as well, but we typically just, when we're running an estimate for clients, typically about 20% of any property will help with that becoming a federal tax deduction that they would not get without doing a study. This is a Ventura retail office, and you'll see the difference here is 39 years because it's a commercial building. Nobody pays to live there like a 27-year property. By the way, if anybody owns Airbnbs or short-term rentals, they should know that it's a red flag if they are still depreciating that property over 27 years like a monthly rental, but they're getting most of their money paid nightly or weekly. That's like a motel, and that should be a 39-year property. I share that every time I get a chance to talk about this because I think it'd be very easy for the IRS to look up all the short-term rentals, see if that property has a 27 or should have a 39-year property because it's a short-term rental.
Yeah, good to know.
It's a red flag. It's something to, if anybody watching has a short-term rental, make sure you have that on a 39-year schedule. It's like a motel. It's something to be aware of. But you'll see with this property, because it's not a condo, the 15-year, this commercial retail building came with a parking lot. It came with, it does own the sidewalks, the curbs, the dumpster enclosure. But just to clarify, if an appraisal is very helpful if we ever run an estimate, but we can actually do the study just on photographs. I find it amazing that our team research all the construction cost of all the components and are able to do this down to the penny and still defend it even without an appraisal or construction documents. I find it incredible. But again, for this client, take out the land value in Ventura. This is in the city of Ventura. So the land value was maybe 800, 900,000, I don't know. But after the land, what was left was 1.7 million. And the way, this is the actual results of the study. We were able to find 244,000 of interior 5-year components. That was about 13.9% of the building. And we found another 8% in the 15-year because there's a large parking lot and a lot of extras in the parking lot. Again, in the 39-year property, this cannot be accelerated. They would still have, for the next 39 years, deductions they can take every year of about 3/4 of what it would be. What they're simply doing is taking about 1/4 of it now because of the tax code. And this 300,000 or 400,000, it offsets 100 grand of federal income tax. So
yeah, that's a big number.
Yeah.
We see a lot of those. For example, somebody purchased the property and they build ADU on it. So let's say I own an investment property, I build ADU.
Yeah.
What's the benefit of me doing the cost segregation? Like, is it a good example for?
Yeah, most ADUs, when people talk to me, it's about 400,000 they're spending. That's what I often hear. If that was a property all by itself, not an ADU, but it would have 20% in it that could be accelerated like normal. That's $80,000 of accelerated deductions for depreciation. In a 30% tax bracket, that'll save them 20 some grand, right?
Yeah.
So yeah, ADUs are definitely something you don't want to miss getting studied when they're completed. And we can run estimates on what the tax benefit is, whatever the renovation is. If we just get a budget ahead of time, we can let you know roughly, if we know what they're spending the money on, and if we know they're all those qualifying components, we can give you an estimate before you start your construction, so you'll know how much additional rent you can get tax-free. I mean, that's what this is. This is a deduction that offsets rental income. So, if you can get a $50,000 deduction, from us that saves you 20 grand, that means, you get 50 grand worth of rent tax-free, right? I mean, it's an incredible strategy. Did I answer your question?
Yes. Thank you. Yeah,
and there also can be additional benefits with something called qualified improvement property, but that's for commercial buildings. You can get more than 20% on qualified improvement properties if it's commercial, on what's done on the interior. And by the way, short-term rentals, Airbnb, single-family homes do qualify for quality improvement property. So if somebody's doing a short-term rental, my understanding is they would, in that ADU, if it was a short-term rental, they would get way more than 20% tax benefit because it's a commercial building. It would qualify because it's a 39-year schedule. It would give you the opportunity for it to be QIP. It's called QIP. And that would be much more. Yeah, I could show you an example of QIP. It's like 70-80% of what was spent was a deduction. It's crazy. So yeah, let's get back to what is really, unless you had a question, I'm sorry.
No, go ahead.
Yeah. The most important thing I feel when I'm talking to somebody is to make sure that people don't do it when they shouldn't. I mean, the worst thing somebody could do is actually do a cost segregation and then sell the property immediately, because all the benefits of this you get over time. And if you're actually doing a study today and you're going to sell the building next year, you don't do it. This is not for flips. Our company believes you should keep the property a minimum of 3 years. And I'll explain why. You get two benefits with cost segregation. You get to defer income taxes. I mean, if you could pull forward $300,000 of depreciation, that would give you, 100 grand of extra tax money you get to keep in your pocket this year, right?
Yeah.
So if you can, so the deferral of taxes today is definitely one of the reasons why people do it, because you may know what you would do with that 100 grand right now to turn it into more profits for yourself. So that's, you should realize it's a great tax strategy just to raise cash. That's one benefit. But you need to keep the property at least 3 years, because whenever you sell that property, all the depreciation gets recaptured and comes out of the gain when you sell the property, right? So if you're selling the property the next year, there's no benefit. I mean, you're not giving yourself time with that 100 grand to really do anything. Also, if you keep the property at least 3 years, I think I've shown you all the value of what's called 5-year property, right? The carpet, cabinet, the linoleum, all that stuff. The flooring is what gets wear and tear. It's very logical. Let's say you sell the property, not in 10 or 15 years, which would be better for you, right? To hold. Cost segregation is a strategy for holding properties or doing 1031s to kick the can on the recapture as well. That's another part of it. That's a great way to go. But if you're not doing a 1031 and you're selling the property, let's say in 3 years, your tax professional should know that we studied that property 3 years ago and put a value to all that 5-year property. It's logical for your tax professional to write down the value of the carpet. Let's say it was 20 grand, and 3 years later, maybe it's 12. I don't know. There's some gray area, but we can guide your tax professional through this if they're not familiar. But the reality is, the longer you keep that property, the more likely all that 5-year property that we put value to at least 3 years ago should be written down, so that when you sell the property, you can shift a lot of the gain in the real estate that you're being taxed on to the land, to something that has no taxes or less taxes than the personal property. 5-year property is called personal property. So it is recaptured at ordinary tax rates. But it is to your advantage to keep the property longer. I would say at least 3 years. Do you have any questions on that? It's
No, it's it all makes sense.
Okay. So, if the basis if you take out the land value of a property and it's around $200,000, you're pulling forward 20% of that, maybe 40 grand, maybe the tax benefit's only 10 grand. It may not benefit you. We can run estimates on anything, but when the basis that you're pulling, the depreciable basis of the property after the land is removed, if it's around 200 grand or less, we're happy to run the estimate, but it may not be that appealing, for the customer to go forward with that study, because there's not as much tax benefit. Yes, it can be used with a 1031. We talked about that. Cost segregation study fees are tax deductible. Yeah, the actual fee to do the study is tax deductible as well. Cost segregation studies have the best benefit on properties when they are initially required. That's the best time to do it, is the year you acquire the property. But again, for the next 5 years, it still works. It still provides benefits. This is probably the most important thing I would tell somebody who's considering cost segregation, and our company, CSSI, CSSI guarantees to defend our study results at no charge if they are ever challenged by a tax authority. In an audit, in our paperwork, we guarantee to defend any audits. And these are our numbers after over 30,000 studies in the last 21 years now. Actually, CSI has not needed to alter any of our calculations, including the 15 audits we've defended successfully. I'll even go further. We defended 15 audits. In one of those audits, the primary IRS auditor really didn't understand depreciation and the tax code. Our company had to spend more money with attorneys to defend and go forward with an appeal, which we did, because we knew our numbers were accurate. The auditor definitely didn't understand some qualifying components. I'll leave it at that. But I think it's important for anybody that's considering cost segregation to know that you've got to be careful. I heard a horrible story from a CPA at one of these CPA meetings. He basically said, in so many words, one of his clients had a friend that was a building contractor that could do it. So they asked him to do it. Everything was fine. They filed the tax return. 3 or 4 years later, an audit popped up. They reached out to the contractor, and the person that did the study couldn't find them. The CPA had to defend the cost segregation with literally no backup information and no assistance from the company that provided the study. And to say the least, the CPA said it was the worst situation he ever had to defend in his life, because it's not something he really understands the value of anyway. I mean, you need a building engineer to put values to everything. And when we go through to defend one of our audits, we explain our methodology. How did we come up with the numbers? Why did we use those numbers instead of these numbers? We're batting a perfect record with the IRS. I don't know if any other cost seg company could say that. And that's why we have no problem guaranteeing to defend our study, because we know they're done correctly. We reduce errors because we provide the #1 IRS approved method for cost segregation, which is called an engineering-based study. And in fact, costs in our company is the oldest, most experienced national engineering-based cost segregation provider. One of the last things I like to mention is I think cost segregation is an inflation strategy within real estate. Most people get real estate, because it's not fiat money. It's something tangible. But please understand the way that the tax code is with depreciation, that you're going to take over 39 years or 27 years, the value of those depreciation deductions in just another 5 years, if inflation is 9%, you're losing about half the value of those deductions that you're going to take in just 5 years from now for the life of the property to 27 or 39 years of depreciation. It totally makes sense to me why someone would want to pull forward as many deductions as they can today to create more tax savings in fiat money, to put that fiat money in anything they believe in, gold, silver, more real estate, whatever. Why wait for a deduction that's losing 9% value every year? I mean, I would definitely, if I used to own a lot of real estate before a divorce, and I would definitely have done cost segregation on my real estate now that I understand it. But that opportunity has passed. So
yeah, that's great information. A quick question for you.
Sure.
Is this, are you guys nationwide? Are you guys limited to a state?
No, we do business all over the country. There's 100 guys like me around the country that represent the company, and we estimate, we type up, let me explain. We type up all the information about the property that we can find. An appraisal is really good to get an accurate estimate. But yeah, we type up something, we send it to the engineers that actually do the work. They look at the property, and since they've been doing the studies for 21 years, they're very good at estimating, you know, that property would probably have $240,000 of accelerated depreciation. And what I've seen, 95% of the time, we do better if we're engaged on our estimate. We do better than our estimate 95% of the time. So sometimes we're close and slightly under, but they're very good at estimating. And we'd rather, our company's philosophy is to under promise and over deliver. So they actually come up with what they expect for depreciation, but they back it off 10% before they even send it to me. So it is a conservative estimate. But the guys that actually do the work, at the same time, they forecast the amount of depreciation that would benefit the taxes of that property owner. At the same time, they calculate how much time it takes to actually study that specific property. And I hate to give out pricing because I never really know. I've always pushed for the best pricing I can for my clients. But if it's a single family home, it may be a couple grand, you know. If it's a 5-story building with retail and, you know, 200 apartments, it could be a 15 or 20 grand study. I don't know. But please know, I don't do the forecasting. It's the people. I don't do the pricing. The people actually doing the work, they estimate, they tell us what the cost is, and we're happy to, you know, provide estimates on any property. What we are known for are economical studies. I mean, there's only a handful of companies that do the engineering-based studies like we do, and I've never lost a bid on that against a head-to-head competitor that's doing the best engineering-based studies. Secondly, so we do grade estimates. I'm sorry, we do quality work for the price. We do the quality engineering-based studies to give all the tax benefits that the property has in it. That's, if you're trying to get the most tax benefits, you want an engineering-based company. So we give good pricing. We do the best studies that find all the deductions that are available. And the third thing we're really good at is actually helping tax professionals who don't understand this. And we've been helping a lot of tax professionals with this. Twice a year, we have CPE courses for a year and a half of you know, continuing education for CPAs. We had over 800 CPAs on our call 5 months ago, and we got 5 out of 5 stars. And I actually have a copy of that I could send out. And one of our agents went through the entire hour and a half and put little headers. What if you're doing a parking lot overlay? How does this impact it? What if you're doing a roofing? What about economic grouping? Can I take my dental office? And the year I buy my dental office, if I do economic grouping of that property with my dental practice, I can apply these passive real estate deductions against the active dental income of my practice. That's known as economic grouping. There's a lot of information and tax information where we can help people apply this to their best tax benefit. We have a lot more information we can share, but that's kind of an overview, and I'm happy to answer any other questions. But
that's great. Just the last question: how long does it usually take for you
Oh,
guys?
to do a study. Yeah. It depends on what time of the year we're contracted. The studies themselves can normally take as fast as 4 to 6 weeks. But right now, while we're 40% over last January, just to give you an idea, our studies are now running 6 to 8 weeks. We just passed our deadline a couple of weeks ago in which to engage someone on a K1 property where they have other investors. Those are filed in March. So we had to get started. We had to be in the building getting pictures by January 20th. That was our cutoff, or we could not guarantee the completion of the study before that March tax deadline. Right now, we're still quoting and engaging for the April 18th tax deadline. But I'm supposed to be in the property, getting the pictures, and have everything on the desk of our engineer to start that study by February 20th. I would say the middle of February, because I don't want to be honest with you, Alex, I'm very uncomfortable getting a study engaged on the last day, because I don't want the study to come out a day before the tax pro has to get it into their tax return and apply those numbers. It makes them very uncomfortable. So I'm telling people, quite frankly, if we can't engage by the middle of February, by the 15th, I think I don't want to be stressing out your tax professional and missing it, getting a deadline of the delivery of the study, a day before. I mean, I would rather have my studies completed a week before the deadline, but
Gotcha.
Yeah.
Listen, it's great information. Thank you.